Welcome, everyone. We're going to give a few more minutes to let some more attendees trickle in. All right, we'll go ahead and get started now. So today we're going to talk about utilizing tax-free growth, primarily focused in retirement, and we're going to take a deeper dive to talk about and explore the strategies of backdoor Roth and Mega Backdoor Roth conversions. So before we get started, a quick disclosure. So the Maximizing Tax-Free Growth webinar contains general information that is not suitable for everyone and contains certain forward-looking statements of future possibilities that, due to known and unknown risks and other uncertainties and factors, may differ materially from actual results. As such, there's no guarantee that any views and opinions expressed here will come to pass. This webinar is presented for informational purposes only, and nothing contained here should be construed as a solicitation to buy or sell any security or as an offer to provide investment, tax, or legal advice. Additionally, this communication contains information derived from third-party sources. Although we believe these sources to be reliable, we make no representation as to their accuracy or completeness. I'm an employee of Marshall Financial Group, a registered investment advisor. For additional information about the firm, including our services and fees, send for the firm's disclosure brochure or visit advisorinfo.sec.gov. So really just telling you this is educational and not specific advice to anyone. It might differ just depending on your individual situation. A little bit about me. So I'm a wealth advisor here with Marshall Financial Group. I do know some of you in the audience, so thank you for joining. I specialize in retirement and small business plan solutions. So that includes like retirement planning, IRAs, as well as 401k plans. I'm a millennial and I currently live in Philadelphia with my wife, our daughter, and two cats. So there's really two common types of Roth conversion strategies that you may have heard of or read about online. So the first two, which is where we're going to focus our time today, is in the foundational or growth phase. Commonly, you'll see this also referred to as the accumulation phase. So for working individuals who are saving their nest egg up to eventually achieve financial independence. So that includes the backdoor Roth IRA, as well as the Mega Backdoor Roth IRA. The other common strategy that you'll see often, we would say is more utilized in the advanced phase or the distribution phase. And that's executing Roth conversions as it relates to managing taxes or preparing for future IRA required minimum distributions. So we're not going to dive into that section today, but it may be something we talk about in a future webinar. So just to set the scene, before we talk more about backdoor Roths and mega backdoor Roths, just want to highlight that this strategy is more advanced when you're building the foundation of your financial plan. So typically this is for saving dollars above and beyond steps 1 through 4. So just want to make sure you have no higher interest debt before you're thinking about this strategy. You have an emergency fund set up. You're taking advantage of any employer retirement plan matching, and you're planning for other short to midterm goals, like potentially buying a house, as saving in these strategies have some restrictions to withdrawing earlier than typical retirement age. So we're going to start with the backdoor Roth IRA and talk about some of the conditions. So in order to be eligible for a backdoor Roth IRA, you do have to have earned income. That can be either W-2 or self-employment income. But if, for example, you're not working and already living off your investments or your savings, you wouldn't be eligible to execute this strategy. Secondly, there are some income requirements or income limitations as it relates to a backdoor Roth. So it's really only required to take these extra steps and do the backdoor Roth if you're single and earning more than $150,000 per year, or married filing jointly and earning more than $236,000 a year. So if your income is greater than that, you are like the backdoor Roth is your only option. If your income is under that, you can contribute directly to a Roth IRA without many or any complications. And then lastly, this isn't a requirement, but this is more preferred, and we'll dive more into it. But it is preferred that you do not have any existing traditional IRA or pre-tax IRA balances. So to talk about some of the facts of a backdoor Roth IRA, so this year there's a maximum contribution, and that's $7,000 for people under 50 years old, or if you're over 50, you are eligible for an extra $1,000 of catch-up, which is $8,000 total for the year. And then the distribution rules for the Roth IRA, and why I mentioned this isn't good for short or midterm goals, is there is typically a tax penalty for withdrawing before age 59 and a half. And additionally, there is something called the Roth IRA 5-year rule, which could incur taxes to you if you take a withdrawal from the Roth IRA within 5 years. And we'll dive a little bit more into that in a future slide as well. So the contributions that you're making will be after tax. So that means the contribution won't lead to any sort of deduction on your income tax return. Purpose of doing this is the qualified distributions are tax-free. So because you're contributing the after-tax dollars, in the future, when you take a distribution after 59 and a half, the contribution as well as any growth associated with that contribution would come to you tax-free, and it wouldn't be reported on your tax return as income. Roth IRAs do provide more flexibility for early withdrawal. So withdrawing prior to 59 and a half versus traditional IRAs or 401ks. So that's a positive to consider why this might make sense for you. And then lastly, there is a tax form that you need to file each year to make sure that you maintain the tax-free status as it relates to a backdoor Roth IRA. So we'll talk through here the steps to take to execute this strategy. So you will need to have both a traditional as well as a Roth IRA open. Preferably the traditional IRA, as I mentioned, will have no balance in it, but it will be where you contribute your cash to. So that's the first account that the money goes to, which you'll see in step 2. You're contributing cash to a traditional IRA. Step 3 will be to convert that cash from the traditional IRA to your Roth IRA. Step 4, and this is important and can often be overlooked, is to actually select your investments and make sure that you're investing in a way that aligns with your risk profile and your future goals. And then you will need to file a tax form 8606 by the tax filing deadline of the following year for every year that you're making this backdoor Roth contribution. You can do this every year. The reason it is considered backdoor is because you're contributing to the traditional IRA first. You're contributing to that account as after-tax dollars, so not taking deduction, and then converting that to the Roth IRA and should not be realizing any tax. So it's a little bit of a loophole in the tax code that allows for this. So I mentioned that it's very helpful or preferred to not have any traditional IRA balances, and that's because of what's called the pro rata rule. So if you do have a pre-tax IRA balance, all conversions are taxed proportionally. So a lot of times what we see is somebody has left an employer, they have pre-tax contributions to their 401k while they were working at that former employer. They say, hey, I'm not working here anymore. I'm going to roll it over to an IRA. Now they have a pre-tax balance. If we look at this example, let's say a person makes a $7,000 contribution to the traditional IRA with intentions to do the backdoor Roth strategy, but they already have a $93,000 existing pre-tax IRA balance from a 401k rollover. So their total balance is $100,000. They go ahead and convert the $7,000, which they believe should be tax-free because they're executing the backdoor Roth strategy. But because of the pro rata rule, that $7,000 is taxed proportionally as it relates to the account size. So that $7,000, only 7% of the $100,000 is or the $7,000 is tax-free, and 93%, so a vast majority of the conversion will actually be reported as income on your tax return and subject to taxes at your tax rate. So this is really important to be aware of. And we will talk about a couple things you can do to avoid the pro rata rule. So I have a couple examples here. Mark and Mary, they're both 35 years old. Their annual income is $350,000, so it's above that income limit where they can't contribute directly to a Roth and have to do the backdoor Roth strategy. They have 401k balances, $500,000, but they have nothing in their IRA accounts. So the pro rata rule only applies to what's in your IRA accounts to calculate the taxes. So Mark and Mary can both execute a backdoor Roth strategy without concern of the pro rata rule. An example two, the same Mark and Mary, about 35 years old. They are earning the same amount. Let's say they're in the 24% tax bracket. They have the same 401k balances, but in this case, Mark's IRA balance is $0, while Mary's IRA balance is $100,000 after she's making the backdoor Roth um, contribution to her traditional IRA. So the pro rata rule only looks at individuals. It doesn't look at you as a couple when you're filing your taxes. So Mark is going to be able to execute the backdoor Roth strategy without concern of the pro rata rule or potential taxes. But Mary would be subject to taxes because of the pro rata rule. And in this example, the ultimate tax due would be about $1,500. That's realizing income of 93% of the $7,000 conversion and taxed at the 24% tax rate. So, like I said, there are some strategies to avoid the pro rata rule. Most commonly, what that is rolling a pre-tax IRA into your 401k. So if you did leave an employer, you rolled over your 401k to an IRA and you're working with a new employer, um, I would say a vast majority of 401k plans will allow you to roll new money into that 401k. In some cases, they don't, where this strategy would not work for you. Um, but that would get the money out of the IRA and show a $0 balance. So you could do a tax-free backdoor Roth conversion. The other option is if you left a job and now you're self-employed, there are what's called solo 401ks if you're a sole proprietor. And that's something that you could open up and you could actually create your own terms on how that should be set up and make sure that it allows for rollovers into the plan to avoid the pro rata rule. So you may be asking, like, what's the benefit of doing that? And really, it is, as this presentation is titled, to maximize or utilize tax-free growth in the future. So the primary alternative to a Roth IRA um, is a taxable savings account or a taxable investment account. Taxable investment account doesn't have any restrictions to how much you can put in. There's no restrictions to when you can withdraw the funds, but it is also subject to two types of tax. So each year, the investment that you choose pays a dividend, and that dividend is typically taxed at your ordinary income rate. And then when you go to sell an investment in that taxable account, you'll be subject to what's called capital gains tax. So capital gains tax is taxed just on the growth of the investment. So say you invested $7,000, you go to sell and it's worth $10,000. That $3,000 of growth or earnings would be subject to capital gains taxes, which is typically 15 or 20%, depending on your income. So what this graph is illustrating is, say, a 35-year-old chooses to make annual contributions of $7,000 to a Roth IRA account. They are earning a rate of return of 7%. At age 60, those contributions stop and they begin taking $30,000 of distributions each year. So this orange line you'll see here uh, is demonstrating what the value of a Roth IRA account would be. The blue line is illustrating the after-tax adjusted value of that alternative investment account option, a taxable account, and the associated taxes that you would expect to pay at these assumed tax rates. So you will see that it does take some time for the benefits really to show themselves, and the benefits really are emphasized when you start taking distributions on or realizing those capital gains. So you see finally this bottom green line is the cumulative taxes paid if you were to invest in a taxable account instead of a Roth IRA account. And over time, that um, does add up to a pretty significant amount. And these differences in account value can be exaggerated if you're in an even higher tax rate than just 20% and 15% for capital gains. So this is the reason that we talk to our clients about it to provide a greater amount of income for them in their retirement years. So just something we want to mention, it's not of a huge concern to us, but the IRS hasn't actually commented or provided formal guidance on the backdoor Roth IRA strategy. If they decide that the loophole is a violation, um, people who have executed the strategy could owe a 6% tax for overfunding the Roth. And if restrictions do come into play at some point, they could require backdoor Roth converters to pay a penalty, but there also could be a grandfather clause. It has been possible since 2010, and it is a widely utilized strategy. It's something that we do work with our clients and talk to them about, but it's just something that is to keep in mind. So a couple other things to note. You should expect to receive a 1099-R form from your financial services firm. So it's really important to file the Form 8606 because if you don't, you could be paying double taxes eventually on that initial contribution. And we highly recommend working with a tax professional if you are concerned about filing that correctly. I also mentioned the Roth IRA 5-year rule. So there is a risk of additional taxes if you do make a withdrawal from the Roth IRA within 5 years of either the first contribution to the Roth or the last time you made a conversion. Although that 5-year hold period doesn't apply to funds converted as it relates to the backdoor Roth strategy, but it can become kind of complicated and confusing to understand. So if you're taking money out within 5 years, it's always a good idea just to double cross your T's and dot your I's. And if you're concerned, working with a financial or tax professional will help. So that's the first part of our presentation. The second half is focusing on what's called the Mega Backdoor Roth. And this is similar to the backdoor Roth strategy, but it is related to 401k and 403b plans. So before we get there, again, I just want to reiterate both these strategies are more advanced and are to be considered um, for people that have excess savings and aren't really sure the best thing to do with that. So the Mega Backdoor Roth is specific to 401k and 403b plans. Um, Unlike the rollovers into a 401k, not all plans are going to allow for this ability. It is a little more rare, but I have seen it becoming more and more widely adopted. There aren't any income limitations or income requirements for this strategy like there is for the backdoor Roth. And the idea of the mega backdoor Roth is that you're able to contribute more than the annual maximum to your 401k. So this year it's 23,500 for those under 50. And you actually can contribute up to a total contribution limit of $70,000. Um, but what you really need to be aware of is that that total contribution limit does include anything that is matched or provided in way of something like profit sharing from your employer. So if you contribute the maximum in salary deferrals of 23,500 and your employer matches another 6,500, so your total contribution between the two is 30,000 for the year. You could consider contributing an additional $40,000 to your 401k by way of after-tax contributions. So these contributions won't be a deduction on your from your income, but it is a way to save more in a tax-deferred account. And what we'll talk about here as it relates to Mega Backdoor Roth is creating those after-tax contributions, making sure that the growth associated with those contributions will also be after tax for you. So that was kind of a lot in regards to that. So hopefully we'll clarify some questions that you might have. So some things up front that your plan needs to allow for you to even think about this strategy is your plan has to allow for after-tax contribution. So it has to allow you to contribute over and above that $23,500 amount. Secondly, in order to maximize the tax-free nature, the plan has to allow for in-plan Roth conversions or allow for in-service rollovers to a Roth IRA. So something that we see somewhat often is if you ever look at your 401k statement, you'll see one balance, but if you look closely, you'll see different buckets. So you may have made Roth contributions, so that's one line item. There's probably pre-tax in there from contributions. That's another line item. There might be another line item for employer matching, and there might be another one for employer profit sharing, and there's different vesting schedules. And then in some cases, you also see an after-tax bucket. Some people actually don't realize that they're contributing to the after-tax bucket because if they plan to max out their 401k and they say max it out in November of the year, their contributions sometimes continue. But since they already hit that max, those continued contributions actually go into the after-tax bucket. So in this scenario, let's say someone has a 401k balance of $1 million. They make contributions into the Roth bucket, and with the contributions and growth, that's worth $100,000. Then there's contributions and growth into the pre-tax bucket of $700,000. And then there's this after-tax bucket that consists of $200,000. $150,000 of that bucket was made by way of contribution, and $50,000 of that bucket are the growth on those contributions. So they actually would separate this out whenever you would go to roll over or take the money out, and tax the growth on the after-tax bucket as they tax the pre-tax bucket. So it would be taxed as ordinary income. And what the Mega Backdoor Roth strategy aims to do is turn those earnings into the Roth bucket so they won't be taxed in the future. So there's a few ways typically we see on how to do this. So there's the in-plan conversion to the Roth bucket. There's an in-service rollover to a Roth IRA, or if you retire or leave the employer, there's typically more flexible options. So to dive deeper on each of these three options you might have, in the same scenario, we'll talk first about an in-plan conversion to the Roth bucket. So unlike in the backdoor Roth strategy where you need these two account types, within the 401k, if your plan allows for it, you can convert the after-tax portion to the Roth bucket all within the plan. So it's still your 401k. But what's important to understand is in most cases, you will only be able to convert the full after-tax bucket. So in this scenario, there's $200,000 and $50,000 are earnings within the after-tax bucket. They will typically only allow you to convert that full $200,000. And by doing that, you would expect to incur or realize $50,000 of additional income that would be taxed at your ordinary income tax rate. So depending on how long you've been accumulating in there and how much growth there has been, the earnings portion and the tax associated with that sometimes can make it prohibitive to execute this strategy. So the next option we look at is what's called an in-service rollover to a Roth IRA. So if this option is available for you, to be honest, it's not commonly available to people who are working and under age 59 and a half. A lot of times what we see is you can take a rollover from your 401k when you're still working if you're 59 and a half or older. Why it's written that way, I'm not sure. That kind of feels like the standard, but it's not required to be written that way. Um, but if this is available for you, whether you're 60 or 40, um, in some cases, you'll actually be able to separate the contributions as well as the earnings on the rollover. So if that is the case, you could roll over the $150,000 of contributions in the after-tax bucket to a Roth IRA. And then when you roll it over to that Roth IRA, that $150,000 starts growing, and the earnings would not be taxed when you take a distribution and a qualified distribution in the future. And in this example, you wouldn't expect tax implications because the earnings piece is remaining in the plan, and you wouldn't expect immediate tax implications. That 50,000 would be taxed in the future when you took distributions from the pre-tax portion of the 401k. The final option is if you retire or leave the employer, they won't hold the money in there or require you to keep it in there regardless of your age. And typically what you'll see is they'll split it into two buckets, a pre-tax bucket and a post-tax or Roth bucket. So in this case, if you rolled over the full account, 750,000 would go to a pre-tax IRA. That's the $700,000 in the pre-tax bucket plus the $50,000 of pre-tax earnings associated with the after-tax bucket. And then the secondary check would be $250,000 rollover to a Roth IRA. That includes the Roth bucket or the Roth contributions and growth, as well as the contributions to the after-tax bucket. And in the Roth, that any future growth in the Roth IRA of that 250,000, that growth would no longer be subject to any future taxes, assuming you're taking a qualified distribution. So again, or similarly in this example or option, you should expect no immediate tax implications. So really when this Mega Backdoor Roth is most favorable, assuming you're comfortable with stocking away more in a retirement account that's more restrictive to access, is when you haven't ever made any after-tax contributions, but you'd like to start. And within your plan, there's an option that's called daily Roth in-plan conversions of after-tax contributions. So what this means is you make $1,000 after-tax contribution, and immediately that is converted to the Roth, and immediately the growth on that initial after-tax contribution is moved into the Roth bucket, and it will be growing tax-free for future withdrawals, and you won't have to worry about this earnings piece that we just talked about. What I will say is that it is not that common to see this sophistication within a 401k plan to convert it on a daily basis. It is common with like big tech companies. We're kind of early adopters of this, and it is becoming a little bit more adopted. Uh, but I wouldn't assume that your plan has this ability. Um, an alternative that isn't as manual is do the after-tax contributions and every year, once a year, maybe twice a year, go in and convert that after-tax portion. It's likely that there will be some earnings associated with those after-tax contributions before you convert. But the idea here is that that earnings portion would be a lot more manageable for you to realize on an annual basis. So there are different ways to think about it to try to minimize taxes and take advantage of what could be growing tax-free for years and years and years. So we talked about two primary strategies today, and here are kind of just like the high level considerations. So back to where we started, and that's the backdoor Roth IRA. What to think about. So potentially there are taxes if you have a pre-tax IRA. Know that there are potential options for you to maybe roll that into your 401k to avoid that. But there are also lower contribution limits. As we talked about, the max for anyone under 50 is $7,000 a year. Um, you do have a wider range of investment options. Most financial services firms, you can invest in the world of investments for the most part, and that would be available within your IRA. It is more manual work. It is a multiple step process, and there is the tax form filing requirement. So that's something to consider and be aware of. And then the Roth IRA does provide more flexible options for early access of funds if you were thinking about FIRE or financial independence and retire early before 59 and a half. The Mega Backdoor Roth. So things to think about that there are potential taxes if you already have after-tax contributions and have been contributing in that manner for some time. Um, if you're not sure, you can look on your statement and it should break it out from the contributions to after tax and the earnings. If it doesn't, you can contact your 401k provider and they'll have that information for you. The Mega Backdoor Roth does have higher contribution limits, as we talked about, up to $70,000 total between your salary deferral, your employer contribution, and then anything you might contribute as after tax. Though the investment options are much more limited. You have your 401k investment lineup, and that's all that you're able to choose in terms of investments. There is a possibility for automating the process. There is no tax form that you have to file either, unlike the backdoor Roth. But 401ks do have some more limitations on accessing the funds early, and that's just important to know. I want to thank everyone for taking the time here this lunchtime and learning more about backdoor Roths and mega backdoor Roths. And if you have any questions, feel free to send me an email or give our office a call. I'm more than happy to talk through this in more detail with you. Thanks, everyone.